Good morning to those of you who have joined us already. We are going to go ahead and get started so we have plenty of time to answer any questions that you may have. So thank you for joining us for today's webinar, Understanding Financial Statements with Todd Davis of MHCPA. Before I hand it over to Todd, just a few quick things. You are welcome to ask questions. We just ask that you submit those via in the chat box that you can find in your Zoom toolbar, and we will get those addressed before the end of the session. And then you'll also receive a follow-up email later today with a link to the recording of the session. So if you want to go back and revisit any of the information that was shared, you will have access to do that. So I will hand it over to Todd and we can get started.
Okay, thank you, Jordan. So thank you everyone for attending. I did a presentation for this group about a month ago. So if you were on that, you might hear some comments repeated from that session, but I'll start out with just an introduction. My name is Todd Davis. I've worked 30 plus years in various accounting roles in public accounting, private companies, and publicly traded companies. Seen a lot of things over the years. Today's presentation is primarily designed to explain the three most common financial statements that business owners look at. I said this the last time. Some of you might think this is too basic. Some might see it as eye-opening. I try to just structure it on what I see every day. And so this is part 2 in a series of these presentations. The first one last month was on best practices in your accounting department. And this one is just on understanding financial statements. And so let's get started. As Jordan said, feel free to just type your questions in. If I think it's a good time to stop and answer it, I will. Otherwise, we'll get to them at the end. But I sense that we'll probably just answer them along the way, and hopefully everyone gets a lot of value out of this. So first slide, basic financial statements in a nutshell. So there's really, for most companies, there's really 3 financial statements that, 3 reports that you're going to want to look at. Maybe 2, but generally 3. So we're going to start with the first one being the balance sheet. And, basically what a balance sheet is, it's a snapshot of the financial position of the company at a specific point in time. And I'm going to show you, as we get to the end, I'm going to show you some examples of a balance sheet, income statement, and a cash flow statement. But I'm just going to kind of talk a little high level here. So what a balance sheet is going to show you, you're going to have 3 sections on a balance sheet. Your asset section, your liability section, and then your equity section. The assets are broken up into current and non-current assets, and I'll talk about that in a little bit. But essentially what an asset is what you own. Just something that you own that you can lay a claim to. In the liability section, same thing. You're going to have current and non-current liabilities. And liabilities are essentially what you owe. Might be money you owe to vendors, might be money you owe to a bank, might be money you owe to the county for property taxes, but it's just what you owe. And then the equity, in its simplest terms, the equity is just the difference between the assets and the liabilities. So if you have more assets than liabilities, you're going to have positive equity in your company. If you have more liabilities than assets, you're going to have negative equity. Some people refer to the equity section as the book value of your company. The equity section in general is going to include any money that you as a business owner have contributed to the company. I don't know if there's anyone on here that's from a nonprofit, but kind of the same thing. I know there's not owners that are contributing, but it's going to be the money that's contributed to the company. It's going to be any funds that are left in the company. So if you make $100,000 this year and you leave it in the company, that sits in the equity section as well. So, but again, we'll We'll talk in a little bit more detail about those types of things later. The second report that we're going to talk about is the income statement, also known as a profit and loss, could also be known as a statement of activity. The balance sheet I didn't mention, sometimes you'll see that referred to as a statement of financial position as well. But the income statement is going to show you your performance, your financial performance over a period of time. So typically when you're looking at an income statement, whereas a balance sheet is going to say on 12/31, these are the assets I own, these are the liabilities I owe. An income statement is going to say over a period of time, be it 12 months, 1 month, 3 months, this is how I've done. And you're going to have sections on your income statement. You're going to have a revenue section. This is things that you've billed your customers or grants that you've received, things like that. You're going to have a cost of goods sold section. Typically, all companies might not, but you know, if you're a manufacturer or if you're buying and selling products to customers, you're probably going to have a cost of goods sold section. You're going to have an operating expense section, which is just kind of everything else that's not part of the cost of what you're selling. You might have a non-operating income and expense section, which would be, you know, things like interest income, interest expense. You might have an income tax section, depending on how your business is structured. And then the bottom line of an income statement is what is your net income or loss. And again, we will get into more specifics on that later. And then the last one is a cash flow statement. Let me jump back here. Yeah. Last one is a cash flow statement. And I will mention this on a cash flow statement. There are two, well, let's just jump ahead. There are a couple of methods of reporting your or keeping track of your activity on a balance sheet and an income statement. And, you know, we'll refer to those as accrual-based accounting and cash basis accounting. I don't know what most of you on the call are doing, so I'm gonna present the statements today on the accrual basis of accounting. And the biggest difference is cash basis statements basically just follow cash inflows and cash outflows. And so, you know, one of the things I talked about back on the balance sheet, and that I'll talk about later on the balance sheet, is something like accounts receivable. So you're gonna bill a customer for work that you've performed for them or something that you've sold them. Now, if you give that customer 30 days to pay on an accrual-based balance sheet, that accounts receivable will sit there as an asset. That's money that you are entitled to. You've provided a service or a good. That's an asset of the company. On a cash basis, it would not sit on the balance sheet. Cash basis, you're only going to report that income when the cash comes in the door. Same thing with accounts payable. If you buy something and they give you 30-day terms on an accrual basis, that's something you owe. You need to report that. On a cash basis, you're probably only going to record it when you pay that bill. So just some things to keep in mind there. But the reason I wanted to mention that is because if you are operating on a cash basis, you probably don't need a cash flow statement, generally speaking, because you know your income statement's kind of going to tell you all the ins and outs that you need to know, but you still might want one. And a cash flow statement is typically broken down into 3 sections. You've got your operating activities section. These are basically the operations of the company. You know, what you bought, what you sold, your operating expenses, that's all going to flow into this section under the net income part of that section. And then if you are doing an accrual basis balance sheet, you're going to have to somehow account for the changes in accounts payable, accounts receivable, and different things to kind of get back to a cash basis type of a statement. Cash flow statement's a little bit confusing sometimes. And honestly, I think most companies that we deal with are probably using a balance sheet and an income statement, and they're not really getting into this, but sometimes you want to see this. And then a second area of the cash flow statement is going to be an investment activity section. And what that basically means is, if you made money in the operating expense or the operating activity section, maybe you want to go buy some equipment now, or maybe you want to look at buying another business, or maybe, you want to invest in some stocks or bonds or something like that. That would all fall in the investment activity section of the cash flow statement. And then you have a financing activity section of the statement, which is going to report maybe any bank loans that you took out or any payments on bank debt that you made. If you were to sell some stock of your company to outside investors, that would show up in the financing activity section. Any distributions you pay to yourself, that would show up in the financing activity section. So those are the three basic statements: cash flow, balance sheet, income statement. And again, we will talk about those in a little bit more detail here in a minute. So I have one comment that says we use cash basis. So that's pretty typical. The next two sessions of this series, I think, are going to deal a little bit more on the tax side of things. And I will say we do see a lot of our customers using the cash basis of accounting just because it's simple. And most when you file your tax returns, you can actually elect whether you want to be accrual basis or cash basis. And this was one of the questions that came up in the last session, was which one's better for tax reasons. And there is no better. It just, it's kind of a case by case thing that you can look at when you start your business, and based on, whether your customers are paying you faster or whether you're paying your vendors faster. That's just one of those things that you might look at to determine whether filing your tax return on a cash or accrual basis makes the most sense for you from a tax standpoint. So, okay, so we will move on. The next thing I think that's important to know is, why do you even need financial statements? And I've come across companies over the years where the owners, they don't really do financial statements. They look at their cash balance on a daily basis or on a monthly basis, and they just like, well, if my cash is up, then I'm probably doing okay. If my cash is down, I'm probably not doing okay. Typically about once a year, when it's time to file your tax return, you have to do something. You have to get some financial statements out just so that you can do a tax return. And like I said, there are a lot of businesses out there that function that way. I don't recommend functioning that way. I think it's important that you have a clear picture of where you're at as frequently as possible. So, I would argue that monthly at a minimum is when you should be looking at a balance sheet and an income statement. Quarterly, maybe, depending on the type of business, but again, the sooner you can look at it, the better. And again, I'll talk about this a little bit more when we get into the actual statements and looking at things. I'll go through kind of line by line and give you some of my opinions on different things with that. So why do we need financial statements? One, there's a lot of reasons, but it kind of goes to who's really using the financial statements. And so the first group that really uses the financial statements is company management. Again, if you own a business, or if you are running a business for someone, I just think it's imperative that you know where you're at as frequently as possible. And so, like I said, company management really needs to be looking at financial statements on a regular basis. I'm pausing because I'm reading a comment here. Yeah. So Nick posted, I have asked clients, what do you do with financial statements once you get them back from your accountant, other than for taxes? Often they do nothing and seem bewildered. Yeah, and that's kind of why we're doing this session, right? So that those that are out there that are bewildered can kind of listen in and be like, oh, okay, maybe I need to be looking at this. Maybe that makes sense. Maybe it still doesn't make sense. I don't know, but that's one of the things we like to do at MH, if the customers are willing, is actually sit down with them and go through them and just explain to them what they're looking at. Because Nick, I think you're right. A lot of people don't know what they're looking at. The tax return gets prepared. I'm not even sure they know what they're looking at on the tax return a lot of times. They're just putting a lot of trust in whoever's preparing that tax return for them. And, it would be a good practice for the clients to ask more questions and try to understand it, because it's really their business and they really need to understand. Yeah, and then Alan posted, depends on the size. Me and my wife, no outward sales presence. I can see as you grow, but my level, it doesn't seem too difficult to keep in my head over a 3 to 5 year time frame. So yeah, and I agree with that too. There are certain sizes of businesses where you can keep it simple. But at a certain point, things do start to get out of hand. I had a client once, they basically bought and sold trailers. So they would go to an auction or something and they would buy a trailer for, let's say, $1,000, and then they would turn around and sell it for $2,000, and they would make a profit. And it was funny, when they started their business out, they basically said he just went around with a briefcase full of cash, and that's how they kind of operated their business when they started out. At the end of the month, the briefcase had either more or less cash than he started, and that's how they knew. So, but they grew out of that, and now they're much larger. But so who else needs financial statements? Lenders. If you are borrowing money, unfortunately, a bank is probably not going to give you money just based on you saying, hey, yep, I've got this business and we're doing great. They're going to want to see some financial statements. They're going to want to see tax returns. They're probably going to want to see projections for next year and things like that. Not only are they going to want to see projections for next year they're going to want to see financial statements, and then you're going to have to explain why you either did or didn't hit those projections. And so it's just, again, it's good to be looking at this stuff on a regular basis. The third group that might be interested in your financial statements is investors. Maybe you've hit a point in your business where you need to try to find some outside investors to help with cash flow or to help you grow and expand. And so again, same thing with the lenders. They're going to want to see, what have you done in the past? What are you going to do in the future? And then they're going to hold you accountable to that. So getting in a habit of doing regular financial statements is just good practice. And then finally, like, who else? Others. I just noticed. Well, we're going to leave that up there, I guess. Others. So, and I don't see this as common, but you may have customers. So you're going to do business with a customer, and they may want to see your financial statements. And it might seem a little awkward giving financials to a customer, but it happens sometimes because they want to make sure that you're a solid business that isn't going to shut your doors tomorrow. They place a large order with you, they're counting on it. They want to make sure you're going to be around. And so they may ask for that too. So the government, for the tax return, they're definitely going to need it. They don't need you to send them financial statements directly, but in the tax return, there is a schedule in there where there is a balance sheet, and the revenue and the expenses in there are pulled typically from an income statement type of a document. So the government's probably going to need that for various things. If you're a nonprofit and you're applying for grants, the government's going to want to see financial statements. So the government might be another entity that you might need to be sending financials to. And then suppliers. Again, some suppliers aren't going to ask for financials, but some might. They want to know how much credit they can give you. They want to know, whether you're going to be good for it. And so they may ask for financials. If you don't provide them, they may put everything on a cash on delivery type thing. So again, another reason just to kind of have them ready to go whenever asked. So the next slide is going to be actually getting into a balance sheet. And so let me see what kind of notes we have here from the chat. Yeah, I got an LOL talking about projections or just made up numbers. Yeah, yes and no, right? And I think no one knows your business better than you do. And so, you have to put something on paper. It's funny, like, in a prior job I was at, when the bank or whoever would have us put budgets together or ask us to put projections together, we would joke with them. They're like, well, what do you want it to say? What do you want that bottom line to be to give us the money that we're looking for? Again, it was just a joke. You can't make up the numbers fraudulently, but you're right. In a lot of cases, projections, you're kind of guessing. You don't know what the market's going to do. You don't know what the effect of the tariffs is going to be. There's a lot of variability in that, but again, you can put something down that's a pretty good idea, kind of keep track of it as you go through the year. And but yeah, the bank's going to be looking for something. Give it your best shot, and if you're wrong, just kind of be ready to explain it. Like, yeah, things didn't pan out the way we wanted to. But it is a good practice to get into. And you're right, I think it was Alan that said it. Yeah, the more history you have, the better you're going to get at it. If you're just starting your business today and you really don't know what the market demand is for it, it's going to be hard to put a budget together. But in your mind, you kind of have an idea of what you think you're going to do. You don't go into business to lose money, so you kind of have an idea. So get that on paper, and then just kind of work it as things go along. So anyway, okay, moving on. So here's a sample balance sheet, and I want to start out by saying these numbers mean nothing. So like this isn't a company that I work with. This is just a standard balance sheet. I've made up all the numbers on here. Some of these items on here you might have on your balance sheets. Some of these items maybe aren't going to be on your balance sheet. Every business is a little bit different, but these are just some common things that I see. So with a balance sheet, the most important thing, 100% of the time, total assets have to equal total liabilities and equity. 100% of the time. So if you remember before, I said whatever all of your assets are, again, these are the things that you own, and whatever your liabilities are, these are the things that you owe. That difference, 832, 482, that difference is what's considered your equity. So again, these have to balance all the time. 832, 832. Assets equals liabilities plus equity. Fundamental rule in accounting. The other thing I want to point out on this balance sheet is that it is on the accrual basis. So we talked about accounts receivable and we talked about accounts payable and accrued payroll. These are things that you would report on an accrual basis balance sheet. On a tax basis balance, or I'm sorry, a cash basis balance sheet, you might not have some of these items. So I'll kind of point that out as we go through it. Again, just some common things. Cash on hand. That might be just petty cash. If maybe you run a restaurant, that might be the cash that's in your cash drawers every day. Just look at that at like cash on hand, physical $5, $10, $20 bills that are in your store. Operating cash is probably going to be money that you have at a bank account. And you might have an operating cash account, you might have a savings account, you might have a CD, you might have different things, but typically you're going to have at least one checking account that you're paying all of your bills out of, that all of your customers' deposits are going into. one of the things I said last month, and I just want to reiterate it, is reconcile your bank account every month. That's going to give you the best chance at finding mistakes. That's going to give you the best chance at making sure everything's being paid on time. Let's see here, what other comments do I have? Yeah. Reconcile your bank account every month. And that's going to go a long way. The one other thing on the balance sheet, and I said this last month too, as an accountant, if I can get comfortable with every number on the balance sheet, like if I know my cash number is right, and I know my accounts receivable number is right, and I know my inventory is right, my accounts payable is right, I can be pretty confident that whatever's down in this equity section is probably right. Because I can, if I can point to every number on here and say, yes, I can tie that out to something, then I'm pretty sure everything else is right. My income statement is the bottom line of my income statement is probably right. Now, it may not be categorized correctly necessarily, but I'm pretty sure the net income number in total is going to be right if I can tie every other number out. So just kind of keep that in mind. Get good at going through every number on the balance sheet and saying, yep, that number's right. That makes sense to me. Accounts receivable we talked about. That's what you're billing your customers. Again, you probably give them terms of 15 days, 30 days, 60 days, whatever it is. That's money that you're entitled to. That's something that you own. That's an asset that you own. Again, with accounts receivable, make sure you're looking at an aging report of some kind every month. Make sure your customers are paying you on time. I see that a lot too, where companies they get lazy and they just let customers get behind. And the longer those debts stay outstanding, the harder it is to collect. And so just kind of stay on top of that. Employee advance, this, some of you may or may not have this. Sometimes an employee will come to you and say, hey, my car broke down. Can you loan me some money? I don't know personally whether I would recommend that as a best practice, but a lot of business owners are generous and they want to help their employees out. And so they might loan them $5,000 and do a payroll deduction for that. That's fine if you do it. But again, that's similar to an accounts receivable. It's money that's owed to you. Just make sure you're collecting it. I have seen in a lot of cases, somebody loans an employee money and then that employee leaves. And then what do? How do you collect that once they leave? You have to be careful with that. Inventory, again, it depends on the kind of business you're in. If you are buying, I mentioned trailers earlier. If you're a company that's buying and selling trailers and you go buy 10 trailers for $1,000 a piece, you're going to put that on your balance sheet as inventory for $10,000. As you sell those trailers, they come off of your balance sheet. If you are doing any kind of work on those trailers to kind of retrofit them for some other purpose, inventory might include some other things. It might include some labor costs. It might include some parts and supplies that you've used to do that. And so inventory can be simple or it can be complicated. Again, it depends on the type of business that you're in. Prepaid expenses. What does that mean? Again, if you're on an accrual basis, I think one of the more common prepaid expenses I see is insurance. So a lot of insurance companies, they will either charge you up front for maybe the first 3-4 months. Maybe they charge you up front for the full year. In an accrual-based accounting world, your income statement should only report 1 month of that expense every month. So let's say your insurance company says, hey, your premium this year is $12,000 and it's for the full year. You pay the $12,000 to them up front. On your balance sheet, you'll probably show $12,000 on here in the first month as a prepaid expense. And then each month over the course of the year, you'll make an entry to reduce it by $1,000 and run the expense through your income statement. Confusing, yes, but it's the right way to do it. the worst thing you can do is run your income statement and, have a $12,000 expense in the month of January when, that wasn't the insurance for that entire month. It was for the full year. So, those are things that are kind of getting into a little bit of the weeds on this, but it's just something to think about. So then, all of those things that I talked about, and there's other things, but all of those are what's considered current assets. And then over here, we have current liabilities. What a current asset is basically anything that can be converted to cash within the next 12 months. That can be readily converted to cash within the next 12 months. So typically your accounts receivable, you're not going to give someone terms greater than a year. Your inventory, hopefully you're going to be able to turn within 12 months. You're not buying things to sell and holding them for more than 12 months, probably. So current basically is what can I turn into cash in the next 12 months? Current liability on the other side is anything that I'm going to have to pay in the next 12 months that I'm currently obligated for. So we'll talk a little bit about that later. One of the ratios that's really important to look at is my current assets, are my current assets greater than my current liabilities? If that number ever gets inverted, where your current liabilities are greater than your current assets, you probably need to look at doing something. Because again, current assets, I'm going to be able to convert to cash in 12 months. Liabilities, things I'm going to owe within the next 12 months. You probably always need to be at least positive in that ratio. Fixed assets, talk about a couple of things here. So as a business owner or nonprofit, you'll have to go out and buy things. You'll have to go out and buy equipment. You'll have to go out and buy, maybe property, maybe a building, things like that. Those type of things typically are going to go on your balance sheet. They're not going to be items that you can expense. And part of that is for tax reasons. The IRS is not going to let you buy a $500,000 building and just write it all off in 1 year. Probably, there are exceptions to that, but they're going to want you to show that as an asset, and they're going to want you to depreciate that over a period of time. Now, again, one thing that gets a little complex when we start talking about fixed assets is there are tax laws that are advantageous for fixed assets. So for instance, if you're a business owner and you go buy a piece of equipment for $50,000, there are tax laws that may allow you to deduct that entire $50,000 in year one on your tax return, which is a great benefit. But if you're showing these financial statements to your bank and you bought a $50,000 asset and you're depreciating the entire thing in 1 year, the bank's going to look at these financials and say, you don't have any assets. And so there are a lot of companies out there that will keep two sets of depreciation schedules, one for tax and then another for their financial statements. And it's perfectly legal. There's nothing wrong with it. But from a financial statement standpoint, so let's say you buy a piece of equipment, the tax laws are going to tell you just by default that equipment gets depreciated at 7 years. And now 7 years, but you might also be able to take something like Section 179 expense. You might be able to take bonus depreciation. Again, there are things that maybe you could deduct that whole $50,000 in year one. In your financial statements, what you really need to be looking at is how long is that asset really going to last me? So if I buy a piece of equipment, maybe the IRS is telling me it's 7 years, but I know that piece of equipment is probably going to last 10. So in that case, I would put it on a depreciation schedule for 10 years, depreciate $5,000 a year instead of the whole $50,000. That really makes my balance sheet look a lot better. And it's probably a truer picture of where you're at, to be honest, because that's an asset you own. You could turn around and sell that tomorrow and maybe get $45,000 out of it. So that's really that's really a better picture of your balance sheet if you are doing those schedules, but it does take some time to keep two sets of schedules. So you've got your, typically you're going to have furniture and fixtures. You might have machinery and equipment. If you're renting space, you might have leasehold improvements. If you own a building, you'll have a building on here. You'll have depreciation on those assets, typically every month, but at least annually. You might have some intangible assets on your balance sheet. If let's say you buy into a McDonald's franchise, for instance, they're going to charge you something to buy into the franchise. That's an asset that you would depreciate over a period of time. If you buy a business, maybe you pay a little more for the business than what the appraisal says the business is worth. You might buy some goodwill. Goodwill basically meaning that, the name of the business has some value to it. The reputation of the business has some value to it. I was trying to think of an example of this, like let's just say in a bizarro world that Jeff Bezos decides to sell Amazon to me for $1 million, but doesn't let me have the name Amazon. I can have the whole business, but he's keeping the name Amazon and I have to rename it something. I don't know that Amazon's worth much without the name Amazon. And so those are the kinds of things when we talk about intangible assets that need to be thought about. But again, that's a little beyond the scope of this presentation. So moving over to the liability section, we talked about accounts payable. Again, you buy something from a vendor. That vendor gives you 30-day terms. In an accrual basis accounting system, that's going to go on your balance sheet as something that you owe. You've received the product or service, you owe them money, that goes on there. Credit card payable, kind of the same type of thing. You've put money on a credit card to buy something. A lot of small businesses use credit cards. That's a liability that really needs to be on your balance sheet. If you're selling goods in the state of Illinois that require sales tax, you're collecting sales tax as you charge customers for things. That's money that you owe the state of Illinois or the city of Champaign or whoever, accrued payroll. Another one of those liabilities that, if you have a payroll that's due on, let's say January 3rd, but it's for the week ending December 31st, this is a December 31st balance sheet. That's really an amount you owe as of December 31st, even though you're not going to pay it until January. So it's really a liability. If you close your doors on December 31st, you still have to pay that payroll at some time in the future to the employees that work those hours. So that's a liability. Payroll taxes would go along with the payroll. Then we get into bank debt, and bank debt's a little different. Typically, if you go to the bank and borrow $1 million, you're not going to have to pay all that in 1 year. Typically, they're going to give you terms of 5 years, 10 years, things like that. But there is a portion of that bank debt that is due in 1 year, that is due in the next 12 months. And that's something that on your balance sheet, you really ought to keep track of. A lot of companies don't, but it really is something you should keep track of. Because again, when I look back at the ratios of what are my total current assets, what are my current liabilities, I know that on my bank loan, I've got maybe 90,000 coming due in the next 12 months. I really need to know how that's going to work with my current cash flow. So, so in this scenario, this fictitious company has $365,000 in bank debt. 90,000 of it I'm saying is due in the next 12 months. The rest of it's due sometime after that. Next 24 months, next 36 months, whatever, just sometime after that. And so it's good to just know that and keep a schedule of that. And then accrued property taxes, again, property taxes are typically payable in the year after they are incurred. So the taxes that, if you guys owe property taxes in your businesses, property taxes that are going to be paid in June, July, August, September, that's really for the tax year of 2024. So again, if your business were to close on December 31st, 2024, that's really a liability of the company, even though you're not going to pay those until June, July, August, September. So it really needs to be on your balance sheet if you're an accrual basis taxpayer. Cash basis taxpayer, again, you just report it as you pay them, and it just shows up that way. We already talked about long-term portion of bank debt. There's other potential long-term liabilities that you could have, but that's the biggest one we see. And then you get into the equity section. And one of the things I'll show you in a minute is that, typically in your equity section, you've got a couple of line items in here. One's just, some will refer to it as retained earnings, some will refer to it as members' equity. It just depends on the type of entity that you have, but you're going to have two lines, typically one for the equity, which is the, any contributions that you've made as an owner to the company, plus any income that you've left in the company from prior year's earnings. That's going to show up in this line, and then this net income line is probably going to be the income from the current year. And that should tie to the income statement that's on this page. That should always go back to that. The balance sheet and the income statement work together, and that's what keeps everything in balance when you're looking at this. So, I'm lost in my slides here. So that's the balance sheet. We're at about 10:44, and we're got two more reports to go through. I don't see any more questions at this point, so I'm going to move on to the income statement. So here's the income statement. Again, fictitious company. These numbers mean nothing. These percentages mean nothing. They're just some numbers I threw on the page just to kind of give you an idea of some common items that you're going to see on an income statement. And one of the things, I'll talk about it too in a minute, when I'm looking at a balance sheet and an income statement, I like to look at comparative statements. So the income statement I did set up as December 31st, 24. Versus December 31st, 23. And for the sake of ease, I just, I took the 24 numbers and I just did 90% of those for 23. So, again, there's nothing special about that. Everything's just 10% less. So, but typically on an income statement, you're going to have, we talked about this earlier, you're going to have a revenue section, you're going to have a cost of goods sold section. Cost of goods sold, again, might include multiple things. It might include, again, if you're just buying and selling something, it's going to include whatever you bought and what you paid for it. If you're actually manufacturing something, it might include raw materials, it might include labor, it might include parts and supplies, it might include some overhead. Like if a large portion of your warehouse is dedicated to manufacturing, you might take some of the utilities and costs of running that warehouse and lump that into cost of goods sold. There's, again, beyond the scope of what we're doing here, but cost of goods sold can include more than just the product itself that I bought. But so just something to keep in mind. And then typically you'll come down to a gross profit number. A lot of companies, and your companies better than I do, but a lot of companies have an idea of kind of what a good gross profit number looks like. For some businesses, it might be 50%. For some businesses, it might be 20%. Every business is not the same. So if you're in a particular industry where there are some peer groups out there that share that kind of information, it might be good to know. Like, again, I mentioned McDonald's earlier. Like if you happen to be a McDonald's franchise, McDonald's will share with you, hey, we want your gross profit to be 60% month over month over month. We want your payroll to be 30% month over month over month. And if you start to get away from those numbers, you've got some decisions you have to make, right? And some of those decisions are easy. Some of those decisions aren't easy, but again, that's why it's important to look at these statements on a regular basis so that there's no surprises come the end of the year. So again, typically you're going to have revenue, cost of sales, and then you're going to have operating expenses, which can include a lot of things. And this isn't everything. These are just some things I thought of, but a lot of times your wages for your employees are going Employees are going to go in there. You might see companies have a separate line item for officer wages. That is something that the IRS, when you file a tax return, that is a line item that is required for certain types of organizations. And so you might have officer wages as a line item. You're going to have your payroll taxes. If you pay health insurance for your employees, you might have a health insurance line. I'm not going to read through all these, but rent is a pretty common item. Utilities is a pretty common item. Repair and maintenance. Again, if you're renting a building, if you own a building, any equipment that you might own, there, things come up that you're just going to have to fix. And so repair and maintenance is a common one. Traveling for business is a common one. Meals and entertainment. It's good to split those out. Meals and entertainment doesn't get you as much of a tax deduction as travel would, so it's good to split those out. You've probably got your lawyers and your accountants that you need to pay. Insurance is a big one. Typically, you're going to have general liability insurance. You're going to have workers' comp insurance, all kinds of insurance. Depreciation and amortization. We talked about that earlier. You're going to buy assets for your business, and you're going to have to depreciate those over a period of time. That's going to go in here. You might have just a catch-all for miscellaneous expense. I've got a lot of clients that don't want anything in miscellaneous. They want everything captured. Personal preference, I think. There's just some things like I don't need to know the minute detail of everything. But some people might want to know that. So again, personal preference. And then you get into some other income and expense items. So maybe interest income, interest expense. And then you might even have a separate section for income taxes. Again, depending on the type of entity that you are, it might warrant a separate section for income taxes. And so after you factored all that in, you get down to a nice net income number. Hopefully it's positive. If it's not positive, maybe that's okay. There are some items in here that are considered non-cash items. So, but then that's what leads us to the cash flow statement next. And so I'm going to talk about that a little bit. I still don't see any new questions, so I'm just going to keep rolling. But your statement of cash flows is kind of a combination of your balance sheet and your income statement. It pulls pieces from both. And so the very first line, if you do have a statement of cash flows, it's going to pull straight from the income statement. It's going to be the net income from the income statement. And what the cash flow statement is trying to do is take your net income and then factor in any non-cash activity that's going through there and factor in any changes on your balance sheet that are not necessarily cash related and come up with a net cash increase or decrease for the period that you're looking at. And so again, these are just some of the common things that you might see on a cash flow statement. Again, you're going to start with net income, which again comes from the bottom of the income statement. Depreciation expense, I mentioned, is one of those things. It's really a non-cash item. It goes on your income statement, but it's really not, you're not paying that money out. You paid it out when you bought the asset initially, but the depreciation every year from thereafter, that's really a non-cash. And again, a little bit of this is getting into the weeds. Cash flow statements are probably, to me, the most confusing of the three statements we're looking at. Feel free to ask questions. I'm going to go through it. I may not explain it as well as you would like, but this is what a cash flow statement is. I also mentioned in the previous presentation that if you're using an accounting software, like a QuickBooks, for instance, QuickBooks will generate all of these reports for you. If you get the data entered correctly, it'll print these reports out for you just with a click of a button. So something to consider if you're looking to take your financial statement reporting to the next level. So we're going to start with net income. We're going to add depreciation expense because it's a non-cash item. And then we're going to look at our balance sheet, really. And we're going to say, okay, accounts receivable, employee advance, inventory, any changes in those balances from the prior year, let's say in this example, I can add or subtract those changes to kind of come up with my cash flow. So for instance, accounts receivable. If last year my accounts receivable balance was $10,000 and this year my accounts receivable balance is $7,000. What I know is that my customers have paid me $3,000 somewhere throughout the year, and it's going to be a net number because that number is going to change every day for the whole year. But somewhere throughout the year, my customers have paid me $3,000 more than I billed them. And so on my cash flow statement, I can show that as positive cash flow. Same with inventory. If my inventory balance right now is 75,000, but at the end of last year it was 70,000, I know that somewhere during the year I spent $5,000 more on inventory than I sold. And so that comes out as a cash flow. So we get to the end of this section, and then we can look at this and say, okay, my net cash from operating activities was $127,000. So then what the investors are going to want to know is, what did I do with that $127,000? In this scenario, I went out and bought a new piece of equipment for $25,000. And I paid $25,000 on my bank loan this year. And I might have paid myself $7,250 as a member distribution, which left me with an increase in cash of $69,000 for the year. I started the year at $180,000. My cash at the end of the year was $250,000, which should, in theory, tie back to your balance sheet cash line item. And again, the way double entry accounting works is everything has to balance. And so in this scenario, it did, which is good. Again, cash flow statement's confusing. Some of you will use it. Most of you may or may not. Banks, again, may or may not want to see it. So those are the three statements. We're at 10:55. Let me hurry through this last slide. Again, just something I mentioned in the last presentation. I want to just do it again. When you're looking at these financial statements, I would recommend you do it monthly. I would recommend on your balance sheet that you look at accounts receivable every month. Make sure your customers are paying you. If they're not, get on them. On accounts payable, look at it every month. Make sure there's nothing in there that's wrong. If you're having cash flow problems, sometimes you let your accounts payable slip into the 30-day column, the 60-day column. That's okay. You just need to make sure you're looking at it so you don't get surprised later. Hey, I didn't pay somebody for 120 days. Now they're calling. Now they're threatening to put a lien on my business. When you're looking at it, make sure when you're looking at it, like, hey, I know I already paid that. How did that get entered twice? Just fix that stuff as you go rather than later. Look at your fixed assets. Make sure you're adding stuff appropriately. Tie your loan balances out every month. When I'm looking at my balance sheet, I want to make sure that the 90 and the 275, I want to make sure that equals what the bank says that I owe. If it doesn't, I need to make an adjustment somewhere. And maybe I took one of my loan payments and I recorded it wrong. Maybe I recorded the whole thing to principal and none of it to interest expense. I don't know. But it's just something that's good to look at on a regular basis. That's the balance sheet. On the income statement, again, I like looking at an income statement comparatively. Look at the prior year compared to the current year. Look at the prior month compared to the current month. Look at the same month last year to the same month this year. Some businesses are seasonal. So it's good to know May this year versus May last year. Where was I at? Look at the monthly column versus the year-to-date column. Again, a lot of these reports can be standard in an accounting software. But if I did 100,000 this month in sales and I look at year-to-date for 6 months and I'm only at 120,000 year-to-date, something might be wrong with my current month. Maybe I recorded 100 in sales and it should have been 10. I don't know. But it's just something to look at. And then I would also recommend setting up a budget. Again, budgets, projections, we talked about this earlier. They're kind of guesses, but they're kind of not. So look at a budget, compare your actuals to your budget, and see where you're at. The last comment, again, if this is all like too much, like I don't know what I'm doing, I just need help, seek professional help. There's firms out there like MH that can help you. We can find solutions that are scalable to what you need. Maybe you don't need a lot. Maybe you just need a little help explaining what your balance sheet looks like after QuickBooks spits it out. We can do that. If you need help from start to finish, we can do that. One of the benefits of seeking help is that, hopefully if you get with the right professional, you can count on accurate and timely report so that you can make good business decisions. And then, the next step above that is just some business insight. There's firms out there like MH that can kind of look at your financials and say, hey, have you considered this? Have you thought about doing this? Just to kind of help you. We deal with hundreds of clients. We see a lot of stuff every day. And those are just the kinds of things that we would be looking for. That is the end of my prepared slides. Thank you for listening. I don't currently see any more questions. If you do have any, you've got a couple minutes to get them in there. Jordan, I'm going to turn it over to you unless some more questions come in.
Thank you so much, Todd. I am going to put in the chat right now before we close out today's session the link to register for our June webinar, which will be all about just small business tax. So if you want to join us for that, you will have the link to register there for that. And as a reminder, I know a couple people jumped on after I had already handed it over. You will get the recording of today's session. So if you want to revisit any of the information, you'll have access to do that. And that email will go out later this afternoon. But I'm not seeing any questions that we haven't covered either. So thank you everyone for joining us. And thank you so much, Todd, for presenting.
Yep. Happy to do it.
Thanks, everybody. Have a good rest of your Friday and enjoy, hopefully, your long weekend.
All right. Thank you.
Thanks, everybody. Bye-bye.